Well, now we're going to turn our attention to capital budgeting. Just as we talk about money markets as being markets for securities with maturities of a year or less, and capital markets to talk about longer-term securities, capital budgeting has to do with investments and expenditures by the corporation that are going to provide or expected to provide benefits over multi-year horizons. So we want to determine and select the profitable, or if we've got to choose among many profitable ones, we may want to choose the most profitable long-term projects. So this also relates strongly to the allocation of capital within the firm. So what are the steps? Well, the first one's the hardest one, the idea generation, or typically the hardest one. And then we analyze the project proposals. And we'll talk about some methodology for this, some quantitative tools for this. We want to look at the expected future cash flows and compare them to what the cost is to today, the initial outlay. The third step is to create the capital budget for the firm based on these analyses of relative and absolute value. And step 4, monitor these decisions and conduct a post-audit to see if there's biases in our capital budgeting process, if we're really identifying the most valuable opportunities for the firm over time or not. If not, then we need to adjust our analysis and our approach to capital budgeting. So what types of capital projects? Well, anything really that is going to provide benefits over more than a year can be thought of as a capital project. And we can divide them into some groups to talk about their risk characteristics. Replacement projects to maintain the business. These are usually fairly straightforward. We're going to replace this old machine with this new machine. Here's the costs, here's the benefits. We know we're already selling that much of our production. So it's a little easier to analyze. Replacement projects for cost reduction, okay, that's still pretty straightforward. Now when we get into expansion projects, these can take on more risk and there's more uncertainty if we're expanding into another country or another region within our country, or expanding our product line with new products. We can also talk about mandatory projects for safety and environment. Analysis of this is pretty straightforward. If it says, well, stop polluting and install these pollution control devices or we're going to fine you $50,000 a day, well, at least we know what the cash flows are. We're going to avoid paying $50,000 a day, and this is what it costs. So in that sense, they're mandatory. The analysis is not going to be real difficult, complex, or long and involved. And then other projects may come up, pet projects of various senior managers, or research and development has to be analyzed in this same framework. So we're dumping money into R&D. What do we expect to come out on the other end in terms of products and profitability? So the general principles of capital budgeting. Decisions are made on changes in after-tax cash flow. So we call this incremental analysis. I mean, we could say, well, if we do this project, what are the financial statements of the firm going to look like? What's our expectation or our estimates there? Okay. But really, what we narrow it down to is saying, what are the changes that are made? So if we spend this much today, how much can we expect back in after-tax cash flows from doing this project? And so we're going to use after-tax discount rates to get the present values of these future after-tax cash flows. And in capital budgeting, because it's incremental, we want to say, well, if we do the project, these are the numbers. If we don't do the project, these are the numbers. So we don't want to consider sunk costs. If you're doing a marketing survey and going out and saying, well, gee, will people buy this new product? Or trying to figure out what they'll pay for this new product, how it ties in with other products that you have, these sorts of things. Well, that's done before the decision is made. So that's why we refer to those as sunk costs. So whether we do the project or not, we're still going to pay for this marketing study. So we don't want to consider those in our do it or don't do it decision. And we must also consider any cash opportunity costs. If there's assets of the firm that are going to be used if we do the project, but if we didn't do the project, those assets could be rented out or leased out or put to some other use that's going to generate after-tax cash flows, then we've got to look at those costs as part of our costs of doing the project. So if we've got some warehouse space, that if we do the project, we're going to need that warehouse space. If we don't do the project, we could lease that out for $5,000 a month. Then we've got to include that and say, well, if we do the project, we're giving up that $5,000 a month in rental income. And we should also consider externalities. Now, externalities can be positive or negative. In the case of cannibalization, they're negative. And this just means that introducing another product may reduce the sales of an existing product. So we need to take account of this for sure. So if a detergent company introduces new improved Blast detergent, we could pretty well suspect that the sales of old unimproved Blast detergent are going to suffer as a result. So we can't just look at the sales of new improved Blast. We've got to say, well, yeah, but then we're going to lose, $100 million of sales over here. So that would be cannibalization. And the timing of the cash flows is, of course, important because of the time value of money when interest rates are positive. We can also have interactions between projects. One issue is independent projects versus mutually exclusive projects. So when we talk about analyzing an independent project, we're saying, okay, just on a standalone basis, is the present value of those future after-tax cash flows larger than our initial cost? And then we just say yay or nay, yes or no, based on that. But say we've got two projects that you can't do them both, like we're considering the costs and benefits of moving the corporate headquarters to Detroit or moving them to Atlanta. Well, clearly we can't do both of those. So when we have mutually exclusive projects, we're going to have to value them both and compare them in order to rank them. So if they're both acceptable, profitable projects, we want to choose the one that's most profitable. That would be better for the wealth of the firm. Now, project sequencing, if you've had finance in college or graduate school, sometimes this is referred to as real options. Because if you do one project, well, it might open up some opportunities for another profitable project. And so we need to take account of this. Say we're deciding to go into another country with our products. Well, if we get a successful launch of these new products, and we paid all the money for the warehousing and infrastructure and everything we need to do this, and then it's successful, well, then that gives us an opportunity or an option to extend that to other products, or maybe a nearby country that could be supported with the same distribution infrastructure, more or less. And so if these add-on projects have value, then we want to consider those in our decision of whether to do the initial project. And unlimited funds versus capital rationing. Okay? Well, for most companies, we treat this as if they have profitable investment opportunities, they'll raise the funds, either issuing bonds or equity, one way or another, and they will do that. But for other companies, they don't have that kind of access to the capital markets, and they're pretty much maybe limited in their borrowing and in the cash that they have generated that's available for investment in capital projects. So in that case, we need to ration this capital. So then we get back into ranking projects. So we can choose if our budget is $10 million, well, we want to choose $10 million worth of projects that add the most value to the firm. And so that's capital rationing. Now, some of our quantitative tools, we saw this introduced in quantitative methods. The net present value is simply, for a simple project, and by a simple project I mean one where all these future cash flows, CF1, CF2, CFN, these after-tax cash flows are all positive. And that initial outlay, CFO, our time zero expenditure, is negative. And in that case of a simple project, we just take the present value of those future cash flows and see if that is larger than the cost. So we're taking it all to present value terms and comparing the future, or at least our estimates of future cash flows, to what the project costs, the initial outlay. And if that present value of those future expected cash flows is greater than the initial outlay, then the net present value is going to be positive. And we give an example of that here. We've got an initial outlay of 100 and we expect cash flows of 25, 50, and 75 over the 3 years of the project's life. So, given a discount rate of 9%, we take the present value of these. So we're just comparing the present value of these, which is this part right here. There's our positive cash flows, to the initial outlay. That's going to be a negative number, as it is here. And here we see the net present value is positive. So if this were an independent project, we'd say, yes, let's accept that project. It's going to increase the value of the firm, or at least that's our expectation based on our forecast numbers and our analysis. So think of NPV as the expected change in the value of the firm in current, that is present value dollars from the project. And as I said, we accept projects with net present value greater than 0. So for independent projects, if there's no capital rationing, the decision rule would be to accept all projects with this positive net present value and avoid all the projects with negative net present values, because their initial cost is not justified by our expected future after-tax cash flows. A related concept, but a little bit different, is the internal rate of return. The internal rate of return, and here's how we put it in the formulation here, it's the discount rate that makes this is our net present value right here. If we put our cost of capital in, that would be net present value. But what we're going to do here, we've got all our cash flows, we're going to solve for that discount rate that makes the net present value 0. That is, it makes the present value of those future cash flows just equal to that initial outlay. We can see an example of the calculation here. It's, there's no closed form solution. Your calculator has to figure out this by trying different interest rates until that net present value gets close enough to 0, and then it says, okay, here's your IRR. Now, we knew that the net present value was positive with a discount rate of 9%. So to get that net present value to go down, we're going to use a higher discount rate. Well, how much higher? Well, here it turns out, and we solved for this on the calculator, that the internal rate of return is 19.44%. And that is, if we discounted each of these cash flows at 19.44%, then the present value of those cash flows is going to just equal our initial outlay. That is, net present value equals 0. So that's our internal rate of return measure. Now, in terms of accepting projects, for independent projects, the rule is accept all projects with an internal rate of return greater than the cost of capital. Well, if the internal rate of return, the return that makes net present value 0, is higher than our discount rate we're going to use, our cost of capital, sometimes called the hurdle rate, that we have to get over for a project to be positive NPV, mathematically it's exactly the same thing. It's equivalent to this. If NPV is greater than 0, then IRR is greater than the cost of capital, that is the discount rate we used to calculate that net present value.